Thank you for being on today's live. Today we are talking about how to read an income statement. Again, my name is May Dodlau. This is yesfinanciallyfree.com is the blog. And if you're on YouTube, the channel is Creative Abundance Now. You can always go to yesfinanciallyfree.com and see the actual income statement we're going to look at today. Okay, so we're going to talk about how to read an income statement from like a company you're looking at on Schwab account or an E-Trade or whatever brokerage account you're looking at, and you're researching if a company is profitable or not, what's going on, how to read it. And honestly, it's not the easiest thing to do, which is why we're going to talk about it today. And first, a little bit about myself, just so you know who I am. I live in Honolulu, Hawaii with my 6-year-old son, Jordan, and my husband, Jamel. And we own this condo, another one down the road. It's an Airbnb business. I used to have a lot of money problems. In 2011, I had so much debt, like over $40,000 in credit cards, lines of credit, all personal debt, not property or anything. I didn't own any property back then. And by 2016, I paid off all that debt by April of that year. Yes. And proved our family's net worth by $500,000. We're making almost $500 a month in passive income. I quit my job. Last day was December 23rd, 2016. Became a full-time mother. Continued blogging at yesfinanciallyfree.com part-time. And also part-time started coaching Finance Freedom Mastermind programs. I created a groups of people who would come together in Zoom meetings, and we would work on the skills that I used to pay off debt and create passive income and improve net worth at the same time. Okay, so these are skills you can learn if you are bad with money. I learned them. I improved our family's finances. You can too. And then later on, we bought property, which is why we own 2 properties. So our life has changed dramatically. And I'm here to help you and myself improve to the next level. All right, so wherever you are. Now, if you're starting at where I was in 2011, ground zero, where it's like lots of debt, have no assets, don't know what you're doing, it's a perfect place to be because I know what it's like and I can relate to you. And I don't judge people. I used to, actually. But after I had all that financial difficulty, I became much more humble. It was good for me. It was good for me. Good for my soul. So you are always welcome here. Any questions are honored. I answer any question you have. Okay, it doesn't matter what your question is. Please ask. Okay, I used to have a chemistry teacher when I was in high school, and he was like, any question is good. Doesn't matter. It's never stupid. Just ask it. And I really was glad he said that because I was more comfortable to ask questions. So don't be afraid to ask questions on any of my live videos. That's why I'm live, so that if you want to ask questions that related to the topic, go ahead and ask them. All right. So if you want to follow along today, I'm going through an actual income statement on my blog, yesfinanciallyfree.com. On the Facebook Live video right now that you're seeing, there's a link right there. You can click on it, go straight to the blog, and you will see the live video on my blog. And you can scroll down. You can listen to me talking because this YouTube video is actually embedded on my blog right now, okay? So if you go to yesfinanciallyfree.com and find the blog post that says how to read your income statement, I'm actually broadcasting live right now. So an easy way to do this is to go to my blog post for today and then follow along. So I'm going to be reading through an income statement from Charles Schwab from a company we looked at this morning. So this is a current company's income statement, all right? And we're going to go through it and we're going to understand it together, all right? Income statements are like the cash flow, the blood flow of a company. They show the money going in and the money going out, the money that they're making and the money they're paying, okay? So that's what an income statement does. So it's a great way to see if a company is actually, making money or not. What is it doing with its money? How much does it cost for it to make money? All these kinds of different factors. We're going to look at that today. And hopefully, once you increase and we both increase our financial literacy together, we become better investors together. Yeah? Okay. So let's take a look. And like I said, if you want to see the actual income statements, go to the blog, yesfinanciallyfree.com. Go to today's blog post. Okay, so we're going to go look at this. The first thing on an income statement that we're looking at here is they say the value is in millions. On the top left side, you're going to see on the picture in my blog, it says the value in millions except for per share data. All right, and quarters are fiscal quarters And if you see red in parentheses, it means negative numbers, okay? So in the company we're looking at today, it's a quarter, they're by quarters, all right? And for this past quarter, for 3 months quarter ending in March 31st, they had a negative total revenue. Okay, so revenue and gross revenue, their gross total revenue was negative $1,665,000,000. Okay, so it's a very high negative number. And as you can see on this income statement, the prior quarter in December, they were positive, all the other 4 quarters. So it was $355 million total revenue at the end of December's quarter, okay, of last year. At the end of September, they had a $547 million revenue number. At the end of June, they had $154 million in revenue. And at the end of March, they had $175 million in revenue, okay? So that is an explanation of the total revenue. So they were doing positive total revenue until the first quarter of March. Now, just a little information, this company is a real estate company, a real estate investment trust company. So they had a lot of difficulty in the first quarter due to COVID, right? And there's a lot going on. I know that in Hawaii, it is illegal to evict anyone right now. The courts are not allowing eviction processes to go through, so people are not paying rent. They're not paying. There's also a law from the CARES Act that you don't have to pay your mortgage, right? If you own a home, you can delay your payment for a while. So obviously this would hurt a real estate investment trust that deals with mortgages. I believe this one deals with mortgages, and that's why it was hit so hard. So a lot of its revenue was negative. I'm not sure how you can have negative revenue. I assume it means they just lost money and they were paying out money instead of making money. I assume that's what it means. I did Google it to figure it out, and they just basically said if the gross profit entry on the income statement is negative, the company is reporting losses, okay? The operating margin should be negative 2. If it isn't, it's an error in the calculation, okay? So let's keep moving on this income statement. Take a look. Operating expenses. So they have cost of revenue. Now, cost of revenue, if you guys, I actually looked that up. Cost of revenue means how much does it cost them to do the services, like the products or whatever it is that they have to sell. So whatever services they're selling, they have to pay a certain amount to create. Maybe it's a product, right? They have to spend a certain amount to create the product before they sell it. That's the cost of revenue, okay? So for this, it's the cost of maintaining or creating or administering the mortgage-backed securities or whatever kind of real estate securities they have, or if they actually own real estate, it's the cost of having that real estate function. That's the cost of revenue. Okay, so the cost of having the real estate available for the rental money to come in is the cost of revenue. So for the end of March, it was $202 million was the cost of revenue. And moving on, restructuring charge. They don't have anything here. I assume at one point they had to restructure maybe for some reason. I'm not sure, but there's no entries here for the past year. Impair assets held for sale. Impair assets held for sale. What is that, right? So here we go. Our first one to figure out what are they talking about, impair assets held for sale. What is that? Okay, for sale. Googling it right now. Okay, impaired asset definition. An impaired asset is an asset that has a market value less than the value listed on the company's balance sheet. When an asset is deemed to be impaired, it will need to be written down. Okay, so the impairment rules under ASC 360 vary depending on whether the asset is considered held for sale or held and used. Held for sale. Okay, so they talk about held for sale. Companies must present long-lived assets held for sale separately in the financial statement and not offset them against liabilities. Statement number 144 requires certain disclosures. Okay, impaired assets usually found in the balance sheet items like goodwill, long-term assets, inventory, and accounts receivable. Yeah. Okay, so they have some asset, yeah, and it's worth less than what they bought it for, than what they acquired for. So they had an asset and they were holding it, and then they're going to sell it. Okay. So in the last quarter, they didn't have any impaired assets held for sale, but they did prior 3 quarters. $3 million worth of impaired assets they were holding for sale. Interesting. Okay. Unusual expense. Unusual expense, which they say is actually income. An unusual expense, which is income. God, these things are so funny. An unusual expense, I think we can understand that. And it's actually, as you can see, it's mimicking the impaired held for sale thing, 336. So perhaps they're using unusual expense to show the impaired assets held for sale, because it is not a usual expense. Okay. Other operating expense. So if they have other operating expenses which are not related to the cost of the good that they're selling, okay? I'm not sure what another operating expense might be. I guess something that's not, that you don't necessarily have to pay for to make sure the good is available. I wonder what it is. Other operating expenses. Let's go see. I'm going to look it up. Other operating expenses. Environmental protection and safety measures, demolition and removal, and planning expenses related to capital expenditures, amortization, depreciation, and impairments of intangible assets and property, plant and equipment expenses from foreign currency and hedging transactions, as well as the measurements of LTI, long-term investment options. How interesting. A non-operating expense is an expense included from activities unrelated to core operations. Non-operating expenses are deducted from operating profits and accounted for at the bottom of a company's income statement. Examples of non-operating expenses include interest payments or costs from currency exchanges. There you go. Those are non-operating expenses. That's good to look it up, huh? Just to be clear, guys, and if you have any questions, please let me know. Checking YouTube, don't see any questions. Okay, moving on. Okay, so we're going through that. That's other operating expenses, and then they have other operating expense total. Okay, it's exactly the same as other operating expense in this worksheet. I'm gonna okay, keep looking. Okay, so total operating expense. So then they add up all these numbers. 202 million, 16 million, 16 million. Oh, sorry, 202 million and 16 million, because other operating expense and other operating expense total is actually exactly the same. All right, thank you for being on the live. We are going through an income statement. You can see the actual income statement in the link underneath this live video. So click there and you can see it with me. We're in the operating expenses section. So total operating expenses are $218 million for this company. That is because they added $16 million in operating expense to the cost of revenue. All right. So that is pretty clear. And if you look on the right side here, they have double repetition lines, right? And the quarter ending last quarter in 2019, they have 205 million is the cost of revenue. And then they have 3 million impaired assets held for sale and 3 million unusual income, right? So they add the 3 million to make 208, and then they add the 14 million, and then they get 223. I guess rounded up is 223. Yeah, so they do not add up. These double lines are not counted twice when they add it together. Okay, makes sense? All right, moving on. So far we've handled total revenue, gross profit. We've done operating expenses, and now we're moving down to operating income. All right. Total operating income. Now, what is that number? The number is basically they took the income number, all right? And usually in this company, it's positive, right? You would think so, because the company will go out of business if their operating income is always negative. Eventually, you would think. But anyway, so their income is usually positive. You're usually making money, okay? But last quarter, they made a huge loss, yeah? Like a really big loss, actually. Okay, so their operating income, their total operating income is negative $1,883,000,000. Okay, so that is huge, negative. Now, the prior quarter, 2019, ending the last quarter of 2019, their income, their revenue was actually higher than their expenses. So they made 132 million in total operating income. Okay, so what they did was they took the revenue number and they subtract the operating expense number to get to the total operating income number. Okay, are there any questions on that? All right, so that's how they got the total operating expense. They just subtracted. So it's kind of like, what is the net income after operating expenses are taken out, basically. They call it total operating income. All right, non-operating income and expenses. Non-operating income and expenses. So let's say you have investments, right? That has nothing to do with your actual business, yeah? They're just held on the side and they might make you income. Or maybe you sell property and that really doesn't have to do with your business, ongoing operations. It's a one-time event where you're selling a property, or maybe, and you just want to sell it because it's old, or you want to move out of the area, or whatever reason, you're selling a property. So if you make money from the sale of the property, that would be a non-operating income. Not operating expenses. If you have to, you have some expense like a lawsuit maybe, but let's look it up. Non-operating income and expenses, just to be sure. Yeah, it's always good to check online and see what the definitions are. What are examples of non-operating expenses? A non-operating expense is an expense incurred from activities unrelated to core operations. Non-operating expenses are deducted from operating profits and accounted for at the bottom of a company's income statement. Examples are interest payments or costs of currency exchanges. I feel like I already went over this already. Yeah, I read that exact same definition before. Here's some more. Lawsuit settlements, yeah. Losses from investments, restructuring costs, gains, losses on sales of subsidiaries' assets, okay? So if you own another smaller company and you sell it, or if they have gains or losses, those are non-operating expenses. Cool, so we got some examples here. Expenses incurred by business which are outside of its main or central operations. Incidental or peripheral. Common is retailer's interest expense. Okie dokie. We got a good idea of that. All right, moving on. So for this income statement, and if you want to know exactly what their non-operating expenses are, you can ask the company to tell you that information. Like if you're really interested in the company and you want to know more, you can ask them for it. Okay, so their non-operating expenses, income and expenses. They have income before. Okay, so this is a section where they're going through their I guess this is a little confusing. Non-operating income and expenses, and then they have the exact same numbers repeated here. Income before tax. Okay, so that is the income before tax. I understand that one. Don't know why it has a big title, non-operating income and expenses, but maybe they will explain that later because they pretty much blended it all together. All right, income taxes, provision for income taxes. So this is how much they put aside to pay income taxes, yes? And since it is negative, they're getting a tax credit, okay? So they're getting $13 million tax credit. Last quarter, they got $2 million tax credit. Prior quarter, $4 million tax credit. The quarter for that, they paid $2 million in taxes. And the quarter for that is a $10 million tax credit. So that's actually a credit. When it's negative under the provision for income taxes, that's a credit. And you can tell because they say net income after taxes. So if you take the taxes out, what is your income? And it actually increases. Okay, so their income before tax is negative $1,883,000,000, but after tax it's actually less of a loss, $1,870,000,000, because they got an income tax credit. Minority interest and equity in affiliates. They have no minority interest and equity in any affiliates. That's why it's 0. So we just move on. Net income before extra items, and there are no extra items so far. It says total extraordinary items are 0. I don't have any extraordinary items. So their net income is here. So it's like a running balance sheet, this sheet. So their net income is negative. It's the same after we did the tax credit, $1,870,000,000. Okay, so I hope you guys are all with me so far. If you have any questions, please ask. And I don't see any questions, so we're going to move on. Adjustments to net income. Okay, so we have our net income number. Basically, the only thing that modified it from the beginning was just tax credits. So now we're going to an adjustment. Total adjustment to net income. So here they have some kind of an adjustment to net income. All right, and I don't know why they have an adjustment to net income here. And it's a $19 million adjustment. So total adjust to net income. It's just an adjustment. I don't know why. So let's Google that. Adjustment. This might be a ask the company question, but adjustment to net income. Final category of adjustments to net income or loss are adjustments made to reflect the increase or decrease in net cash resulting from the change in the value of the financing assets or liabilities of the entity during the financial reporting period. A common financial activity is a bank loan. Oh. Okay, so this, I guess you can find out what this is from the balance sheet. So basically, they're adjusting net income. It might be because they had a bank loan. Adjusting net income. The calculation of adjusted net income begins, as its name implies, with net income. Okay, duh. Net income is the sum total of all revenue, expenses, debts, taxes, interest, additional income. I'm going to open this another tab and see if they actually say something worthwhile. Okay. All right. Metrics that reflect profitability at various stages are generally used to evaluate relative financial strength of a company. However, when a business is being sold, potential buyers determine its value as an acquired asset rather than simply looking at its net income. Adjusted net income is an indicator of how much a business would be worth to new owners if they bought it. While primary revenue can be assumed to remain stable as long as normal operations remain stable, several kinds of expenses and income streams shift when a business changes hands. Adjusted net income accounts for these factors in addition to the company's bottom line. So to determine adjusted net income, you start with net income. Net income is the sum of total of all revenue, expenses, debt, taxes, interest, additional income for a given period. Like other accounting measures, it is susceptible to manipulation through such things as aggressive revenue recognition or by hiding expenses. Well, that would be unethical now, wouldn't it? Net income is the most comprehensive metric of profitability for a company's operations. However, under new ownership, those operations might change. One major change may involve the salaries of the company's current owners and management. Many business owners pay themselves below market salaries to help the business along in early stages, or they collect the difference in dividends at the end of the fiscal year. If a new owner hires someone to run the business at the market rate, certain amount of revenue is needed to cover this salary increase. Okay, that makes sense. Potential buyers need to know how much capital they have to work with to cover all the changes they would implement as new owners. To estimate the value of a company in this context, various expenses are added back to the net income. In addition to the salaries of owners and management, this includes depreciation and amortization of assets, one-time payments made for events such as lawsuits or equipment purchases, personal business expenses of the current owner, and rent if the property is not owned. Net income accounts for all actual expenses and income generated for a period, while adjusted net income reflects only those figures that would not change under new ownership. Wow, that was a good definition. Okay, so going back. So back to our sheet, adjusted net income. They adjusted by $19 million negative. So if you bought this company, you would have to add in another $19 million to have it operate the same way. And that has been the same number every quarter. So the income available to common, excluding extraordinary items, which they had no extraordinary items, is $1,889,000,000. And they basically just added in this adjustment to net income. The income included, and it's the same, the second line is whether you include extraordinary items or you exclude them. And they didn't have any extraordinary items in this balance sheet, so this is the same number twice. Earnings per share reconciliation. Okay, so what they're doing is they're figuring out how many shares outstanding of stock, and then they're figuring out how much earnings is there per share. Okay, so the first thing is they have the basic primary weighted average shares. So they're saying how many shares are there? The basic primary weighted average shares, what does that mean? Okay, let's find out. Average weighted shares. Like learning to speak a new language. That's why people understand. Basic average weighted shares. The earnings per share calculated using the weighted average shares outstanding is actually the basic EPS. The formula is as follows. Basic EPS is net income minus preferred dividend divided by weighted average shares outstanding. Okay, let's skip that. Moving on. What is basic? Here we go. Basic versus diluted average number of shares. Here we go. This is something you will see. The dividend gangster. I'm looking at a website called the dividend gangster. Okay. Basic versus diluted weighted average number of shares. Whilst pursuing the financial statements of firms while performing an analysis, often the EPS is listed in two forms: basic earnings per share and diluted earnings per share. Basic earnings per share is calculated with the net income divided by the weighted average number of shares. Diluted earnings per share takes a little more work. With diluted earnings per share, the weighted average number of shares is adjusted by the number of shares that would result from converting any dilutive securities to common shares. I see. This adjustment is then adjusted again to adjust for any shares that could be purchased on the open market from the proceeds of the conversion, based on the average share price for the fiscal period. The total list of dilutive securities is vast. For an example, here are some things to look for: convertible bonds, convertible preferreds, outstanding warrants, employee options. Still didn't answer my question, but let's go back. Okay. So the basic primary weighted average shares, they're saying how many shares are there? Okay, there's 273 million shares out there. Now, the basic primary earnings per share, excluding extraordinary items, okay? So they're taking the earnings, which we know is negative 1,889,000, and they're dividing it by 273, right? and they get negative $6.91 loss per share. Okay. Diluted weighted average shares are 273 million. That means that there are no options outstanding. There's no preferred shares, there's no convertible shares that can be converted to stock. So if it's diluted, it means they took there's a lot of things going on in a company. They can issue different types of securities that can later you can convert them into stock, all right? So if you want the diluted shares, it's the number of shares that could possibly be in existence, not only the ones that are actually in existence. And I guess they do not have any convertible ones because it's the exact same number, right? So as you can see, 2 quarters ago, it was not the same number. It was 291 million, and the average shares were 273. So there must have been some shares that could have been converted. Okay, so it's the exact same number per share because the diluted and the basic are the exact same number. So the earnings per share for both are going to be the same, negative $6.91 a share. Common stock dividends. So this is just how much do they pay. Dividends per share is 40 cents. All right, so they're paying 40 cents per share for common stock. The gross dividend for common stock. Okay, dividends per share, common stock primary issue, and then the gross dividend is 0 for the first quarter. Gross dividend 0, and then the common stock primary issue dividend per share. It's a little confusing, yeah, guys. How can the gross dividend be 0 and the dividend per share be 40 cents? See, this is why you go through and check these things. Dividend per share. Okay. Dividend per share. Dividend per share, dividend per share. How to calculate dividends per share. Dividend per share is the sum of declared dividends issued by a company for every ordinary share outstanding. The figure is calculated by dividing the total dividends paid out by the business, including interim dividends over a period of time, by the number of outstanding ordinary shares issued. Okay, that's nice, but how can you pay 0 and have 40 cents per share? Sorry. What is that about? That's confusing. The formula for dividends per share, annual dividends. Aha! Here we go. It's because they took the annual dividends and divided it by the number of shares outstanding. That's why. So they didn't pay dividends in that quarter, but the average dividend per share is 40 cents because they took the total of dividends paid annually and then divided by the number of shares. Does that make sense? Let's look. So they did pay 47 cents, 31 cents. I don't know, guys. It's a little confusing. Not sure if I understand that. Gross dividend. So they're saying they took the annual divided by the number of shares. So that's like the 40 cents. Okay. And then the gross dividend for that quarter, there was 0 because they didn't pay any. All right. Let's go with it. Supplemental items. And that one I would probably, if I was really interested in this company and wanted to invest in it, I would probably get an explanation of that more clear. Okay. Pro forma net income. They don't have anything there. Pro forma net income. My goodness. Pro forma net income. Pro forma net income. All right. What does that mean? Pro forma. A company's protected financial status is used to paint a picture of what the financial statement may look like at some point in the future. Pro forma net income is the net income shown as a result of these assumptions and projections. I see. They did not project anything, but if they wanted to, they would put it here. Okay, like projections and stuff. Supplemental items, interest expense. Okay, so they have interest expense. This is another item they're putting in, 167 million in interest. Normalized income, total special items is 0. Normalized income before taxes is 1,883,000,000. Normalized income before tax. So the tax was, we had it up there, 19 million. Okay, so they don't know where they got the 183 million though. We're almost to the end and I'm running out of steam. Okay, let's finish this up. Normalized income before tax. Here we go. I'm gonna look it up. Normalized income before tax. Normalized earnings are typically referenced during the sale of a company or business. Step 1, refer. Okay, how to calculate normalized earnings. What are normalized earnings? Normalized earnings are adjusted to remove the effects of seasonality, revenue, and expenses that are unusual or one-time influences. Normalized earnings help business owners, financial analysts, and other stockholders understand a company's true earnings from its normal operations. What is normalized earnings in accounting? Normalized earnings are adjusted to remove the effects of what I just said. Okay. The company earns $100 in January and $150 in February and $200 in March and uses a 2-month moving average. Its normalized earnings would be $125 for February, $170 for March if they're doing a moving average. Normalized income before taxes represents income before taxes excluding non-recurring charges or credits. Okay, so they're excluding non-recurring charges or credits. So where do they have non-recurring charges or credits? That would be the impair assets held for sale, but there's 0 there. Maybe it's the other operating expense. Oh, the adjustment, maybe it's the adjustment to income, the 19. Go back. Because they're normalized before income before tax is 183. So that means they put the tax back in. The tax was a credit and the credit was 13 million. So with the tax put in, it's 1,870. No, sorry. Am I going the wrong way? Yeah, the tax would credit, so you have to subtract it out if it's not there. Yeah, so then it would be 1,896,000,000. And then they took the tax out. Yeah, see, I don't get this number. So this is something you'd have to figure out. I don't know what they're talking about there. Income tax, they have income tax exempt impact of special items. And that was the income tax. We already had that. Income tax exempt impact of special items, 13 million. Normalized income after tax, and then they just subtracted it out. We know that already. Normalized income available to common is 1,889,000,000. That's what's available to common shareholders. And then the basic normalized earnings per share and the diluted normalized earnings per share is negative $6.91. Okay. That's basically, we went through this income statement. I hope you gained a better understanding of it. I did run out of steam at the end. I will be writing about it in my blog posts. So definitely check out the blog a little later to see it in writing. But thank you so much for being on today's live. I hope you enjoyed it. Remember, the income statement we were analyzing is on my blog, so you can follow it there. Okay? I hope you have a great day. I will see you again. I'm live every weekday, Monday through Friday. Same time, 9:30 a.m. Hawaii time, 3:30 p.m. Eastern time. Usually I'm live for 10 minutes. Today was a lot longer because we were doing kind of more an extensive look at an actual income statement, so sometimes a little more in depth. So thank you so much for being on, and I appreciate it. If you have any questions, let me know, or comments. There is a blog post underneath this live video if you're actually on YouTube. If you're on my blog, thank you so much for being there. Get on the email list if you haven't. Go to yesfinanciallyfree.com, put in your first name and email address on the right side on the website, or scroll down on your mobile device and then hit the big red yes button, and you'll get a free ebook, Working Parents Guide to Financial Freedom, sent directly to your inbox, as well as get updates on when I'll be live and what I will be talking about. So I hope you guys have a great day. I will see you again Monday. Aloha and thank you. Subscribe to the YouTube channel if you haven't done so already. And if you are on